Before we discuss different types of financial assets, let's make sure we understand what we mean when we say financial asset. To qualify as a financial asset, three important conditions must be met. It must be 1. Something you can own, 2. Something of monetary value, and 3. That monetary value is derived from a contractual claim. That last condition may be hard to grasp, but it'll be clear in a few minutes. So, financial assets are different than physical assets like land or gold. With land and gold, you can touch and feel the actual physical asset, but with financial assets, you can only touch and feel something, usually a piece of paper, that represents the asset of value. The three financial assets we will discuss in this lesson are money, stocks, and bonds. Money is an official medium of exchange consisting of cash and coin defined by a government. Money, currency, cash, legal tender, they all mean the same thing. They are all a symbol of a central bank's commitment to sustain, as best they can, that money's value. Money is a financial asset because the value of the asset itself doesn't come from the paper or metal it is printed on. It comes from the faith and credit of the government that issued that money. Money is obviously an important financial asset. Without a common medium of exchange, we would all need to barter with one another, trading whatever goods and services we have for something else we need, or trade what we have for something else we could then trade again with someone else who has what we need. Imagine how complicated that can get. As of March 2014, there was about $1.26 trillion of U.S. money in circulation, according to the Federal Reserve. Another important financial asset in the U.S. economy is stock. Like money, stock is just a piece of paper that represents something of value. That something of value represented by stock is an ownership stake in a business. Stock is also referred to as equity, because when you own stock in a company, you have equity in that company's profit. For the simplest of examples, let's imagine little Jane's lemonade stand. Jane has $4 to start her business, but she needs $10. Jane's parents give her $3 in exchange for 30% of her business. Her friend gives her $1 for 10% of her business, and her brother gives her $2 for 20%. Now Jane, her parents, her friend, and her brother all have stock in her business. As simple as that example is, it describes stock. Now the complexities come in when we try and put a value on that stock. The value of a share of stock depends on many factors. One share of stock in one company is not the same as one share of stock in another company. The number of shares each company has issued will impact the value of your share, as will the size and profitability of each company. Anything that may impact a business, good or bad, will change the value of stock. Those are just very basic, fundamental factors that can impact the value of a share of stock. Macroeconomic trends impact individual stock prices as well. Thousands of books have been written trying to figure out the golden rule that determines exactly what a share of stock is worth. The value of stock can vary minute to minute, even second to second. If you calculate the total value of all stock listed on the two largest stock exchanges in the world, the New York Stock Exchange and NASDAQ, both located in the United States, the market capitalization is over $30 trillion as of February 2014. The last financial asset we'll discuss are bonds. In simple terms, bonds are loans. When an organization, perhaps a company, maybe a city or state, or even the federal government, needs money, they can issue bonds. There are many different types of bonds, but they are all debt instruments where the holder of the bond is repaid their principal investment plus interest at some future maturity date. The only way a bondholder doesn't get their money is if the entity that issued the bond goes bankrupt. Because bonds are a legal obligation to repay debt and stock represents ownership, which comes with the potential to make or lose money, bonds are generally safer investments than stocks. The total market cap of the U.S. bond market is estimated to be at about $40 trillion as of the end of 2013. Let's review. Financial assets are assets that 1. An individual or organization can own, 2. Have a financial value, and 3. Derive that value from a contractual claim. Money, stocks, and bonds are the main types of financial assets. Each is something you can own, and each has some amount of financial value. For money, the contractual claim is against the central bank of the government issuing the money. For stocks, the contractual claim is with the company that issued the stock, and with bonds, the contractual claim is with the municipality, corporation, or individual that issued the bond. Money, stocks, and bonds are important financial assets that serve different purposes for individuals and organizations. The type of financial asset you need will depend on whether you need a medium of exchange or a place to let your money grow. But like ingredients in your favorite pastry, each of these financial assets is needed to have a healthy, robust economy.